What is up, you guys? Pete Carlo here, and today I want to go over my $0 to $50,000 portfolio. Currently, what I have in it right now and what my plans are. So, for those of you who do not know what the $0 to $50,000 challenge is, it's something that we started 2 months ago. You can see the other videos; I'll link them here, or you can go to the playlist called $0 to $50,000 challenge that's currently on our channel. The reason I wanted to create this is because when a lot of people start investing or start trading, they kind of get discouraged because they don't have as much money as they see somebody like myself or maybe their peers have. And it just seems like, if you're investing with $2,000 or $3,000, that you're never going to get to that $100,000 mark, $200,000 mark, those big money marks that, really why we're all investing and why we're trading. Now, if you want to learn more about trading, we're not really going to be talking about that right here. That is all on my Traders Helping Traders YouTube channel I just created. I'm going to put that down below. We are going to look at a little bit of technicals because I feel that it is important to see what the trend of a stock has been doing for the past 3 years to kind of get understanding of are you buying this at a very high point, a very low point? And it's not that technicals matter really when it comes to fundamental investing, but technicals do have their place when it comes to trading and also when it comes to investing. So what we're going to do is go through each and every one of the positions I have. You can see right here, we only have $2,000 in this portfolio. So the goal is to reach $50,000 by putting $100 per week into this portfolio, and then probably not going to sell a lot of positions. I have sold a couple and we'll talk about that, but the goal is really to hold the positions and to really ride this out for the next 5 years and try to get 22% returns per year. So far, I think we're doing pretty good. We'll have to look at it. And that's why you'll see that this is a very aggressive setup for a portfolio. If I was building a regular portfolio, this is not what it would look like. But we need some aggressive returns. So that's why we're very tech heavy. That's why we're pretty much in a lot of small cap companies, because they're the ones, in my opinion, most of them that are undervalued. So please don't think by any chance that I'm telling you set your portfolio up like this. This is because I'm trying to do something that's very, very aggressive. If I was just trying to set up a retirement portfolio or a long-term portfolio, I would have way more dividend companies in here and I would have the entire thing set up a different way. So I want to preface this video by saying this is a very aggressive way to invest, and I don't recommend everybody to do it. However, a lot of these companies I believe are undervalued, and in the market right now, there's not a lot that is undervalued. If the S&P 500 continues to fall, maybe to about the $300 level, or on SPY, $3,000 level, we could see more companies that are probably a bit more attractive and fairly valued. But let's just get into it. So the first one is JWM, and this is Nordstrom, or JWN, I'm sorry. And this is Nordstrom. So they own Nordstrom, they own Nordstrom Rack. They have a $1.9 billion market cap. They have an EPS of negative $2.92. They do not have a PE ratio because they are not a profitable company. They do not have a dividend. Now, retail has been getting hammered for years and years and years. If we look at this 3-year chart right here on Thinkorswim, we had highs of 67.75 at one point. Lows were almost there at about $11.72. And basically over the past 3 years, we have just been in a descending trend, which is not good. You want to invest in companies that go up. You don't want to invest in companies that go down. The only time that you would invest in a company that's going down is if you feel that they have something in which they can recover the company with, or if it's such an attractive value that you feel like you can't, mess that up and you can't miss out on owning it. And so that's kind of where we are with this. Let's take a look quickly at the fundamentals. I always look at an income state and a balance sheet very briefly. This is not how I deep dive a company. This is just quickly to show you what their revenues are, what the company's been doing, and are they making more money or losing money. So right now, all of these numbers are in millions. So we have 2016, $15.4 billion, 2017, $14.7 billion, $15.47 billion, $15.86 billion, and $15.52 billion in 2020. So they are growing revenue year over year, but not by much. So, from 2019 into 2020 right now, we should see revenue growth as long as they make 300 million or more by the end of the year, which I think they obviously will. The other thing you want to take a look at is going to be the net income. So net income, We'll just do 18 to 20. 18 is 437 million, 19 is 564 million, and 2020 is 496 million dollars. So not that much of a growth in net income. Something that you're going to want to see when we get more into the companies later on is that not only are profits scaling, not only are sales scaling, but the profits are scaling. Because if you're making more money from a revenue standpoint, but you're losing more money from a profit taking standpoint, that is usually not a good business model. Now, let's take a look at the balance sheet. I like to see a 2-to-1 or at least a 1-to-1 total assets to liability. So right now their total liabilities are total assets are 9.7 billion. Total liabilities are 8.7 billion. Now, this is not something I would normally take an investment in. I do not like retail. I do not like clothing companies for a lot of reasons. The other thing is Nordstrom is a high-end luxury, retailer. So if a recession were to happen like we have right now, or if we were to go into any sort of economic slump, the first thing that people are going to do, rich people are going to do, is going to be stop purchasing the high ticket items at places like Nordstrom. That's the first thing they're going to do. And this is very, this is reflective in the stock price. The stock was trading at $39 before the Rona, and now it's all the way down to $10. I am simply purchasing this stock for two reasons. Number one is to diversify my portfolio slightly because I have a lot of tech, and also because I feel this is such I don't want to say undervalued, because I don't think it's really undervalued, because this sector has been murdered. And it's not like they're in a great financial situation. I think it's a very fairly valued stock. If Nordstrom were to go up to $21, I would definitely sell over the next couple of years. I think they have the chance to do that. It really depends on how the whole Rona situation plays out. If we go back into another lockdown, this could be very bad for them. However, if we can get a vaccine out, if things go back to normal pretty soon, if we have a record holiday, a holiday season, maybe we could see a big push up. The other thing on the weekly too is we have a pattern. It's called a descending wedge, which you can see here, which is essentially where your resistance points constantly go down, your support points constantly go down, and we reach what's called the apex, or like the head of this wedge. We've also been squeezing for a very long time, and we have a divergence, which is when the RSI kind of moves the opposite of the price action. So price action's down, RSI is going up. It's kind of like, think of it like if you were to heat water and it creates steam, and then you put the steam in like an engine, and then it creates combustion, and the combustion drives the machine. It's kind of the same thing with this, where like when we get this combustion on this type of pattern, we usually see a push up. This is not something that's going to take like, a month, but maybe by the end of the year, if JWN is trading at like 18, 19 bucks, I will probably get out of the position. The next one is going to be Cisco, which Cisco is also, I feel, probably undervalued at this point too. It's had one hell of a sell-off. But let's kind of go through this. So market cap, $152 billion. We have an EPS of $2.64 and a very, 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 very attractive PE of 13.62. Overall, industry average, a PE ratio below 25 is very, very good. A PE ratio of 20 is usually fairly valued, and a PE below 20 is extremely undervalued. At this price too, if you were to enter here, you're getting a 4% dividend per year. Will they cut that if things go south and the economy doesn't recover as fast as people are expecting? Yes, they definitely will cut that. However, right now, a 4% dividend is very nice, and it doesn't seem like at this point that they're going to end up cutting it just yet. But let's take a look at the fundamentals. So if we look at the income statement, these are displayed in millions as well. Don't ask me why the hell they do that. Some are displayed in thousands. So 2018, $49.3 billion. 2019, $51.9 billion. So a great increase of about $3 billion in revenue year over year. 2020, $49.3 billion. We still have a whole nother quarter left, so I expect them to beat their 2019 numbers in revenue pretty easily. If we take a look at total net income, we have $11 billion in 2019, 11.6, and so far in 2020, 11.21. I think they're going to beat that too. So pretty good sign, right? Growing revenue year over year so far, as long as the final quarter of the year is good, and growing net income, which is great. Now, total assets, $94 billion versus $56 billion. So a 2-to-1 total asset versus total liability on the balance sheet. That is very important, because during economic rough times, you want to know that a company has the money on the balance sheet to not only say, not have to cut the dividend, or not have to lay off employees, or maybe there are other companies out there that are not doing too well, and then they can scoop in and buy that company. So I love this. Cisco overall, I didn't really talk about them too much, but they are a chip maker. They do a lot of other things too. Let me see if I can get a quick little breakdown of them. Cisco summary. Give you guys an understanding of what they do. Cisco is an American multinational technology conglomerate headquartered in San Jose, California, in the center of Silicon Valley. Cisco develops, manufactures, and sells networking hardware, software, telecommunications equipment, and other high technology services. So it's not like they're just like a chip maker by any chance or anything. They also do a lot of other telecommunicative things. Overall, I like the company. One of the big reasons I'm in it, however, is just because of how undervalued the company is right now. Trading at $36 a share. Looks like it could fall down technically to like $32, but trading at $36 a share, I think that this is one of the best companies to buy right now that's actually like fairly valued or undervalued. I believe this is very undervalued at this point. So I'm probably going to end up building this into a pretty big position. The next one is going to be Vista Outdoors. So Vista Outdoors, they're like an outdoor hunting, camping, hiking company. They're an outdoor retailer. They do sell a lot of ammunition. They are based around hunting. So obviously with it being fall and with people being very, I should say, not how do I explain it? People not really liking the situation of where the country is going right now, and potentially we could have, I'm not gonna say a fallout, but people are loading up on ammunition. Let's just put it that way. People are loading up on ammunition. We've seen Smith & Wesson go up a lot over the past couple of months, and Vista Outdoors is one of those companies that I believe we could see a pretty big move up in the next year, especially if we re-lock down the economy, because more people will be forced to do outdoor activities, not only next spring, but in this fall and winter as well. Market cap, pretty small, $1.2 billion, EPS negative $1.70, zero, no PE ratio. They're trading at the higher side. This is a smaller position of mine, but I do believe that we're going to have a bigger than normal hunting season right now, especially if you look at Google Trends and see how hunting has been trending, people looking for how to get their tags, how to get their they're hunting, not only their tags, but the courses, like, because there's different safety courses. A lot of people have been searching that up. So it's probably gonna be a lot of new hunters, and a lot of new outdoors men and women. So I'm pretty bullish about this. As well, let's see, design, manufacture, custom products. Let's see, the company serves as an outdoor sports recreation markets through a diverse portfolio of over 40 different brands. Maybe I'll do a deep dive on this for you guys actually too at some point. Let's take a look at the income statement. My goal of this is just to get you guys to look at maybe some potential new investments. And then if you guys are really interested, I can go through and do a deep dive on all of these companies. So right now, the 2018, they did $2.3 billion in sales. 2019, $2 billion in sales. 2020, $1.7 billion in sales. So obviously they've been downtrending from 18, 19, and into 20, which is not a good sign, but we'll talk about that in a minute. In 2018, they lost $60 million. In 2019, they lost $648 million. And in 2020, they lost $155 million, which is really not good. But they did lose less money 2019 to 2020 while gaining more revenue, or actually declining in revenue, I'm sorry. So overall, from a sales perspective, that's really not the best. However, like I said before, I think that this is kind of like a 3 to 7 month play where if we get a re-lockdown occurring, that more people will be forced to do things outside. Therefore, more people will be camping, hunting, maybe snowboarding, skiing, and spending more time outdoors in general. So right now, their total assets are $1.3 billion, total liabilities $941 million. So they do have some money on the balance sheet. This is not something that I'm extremely bullish on. This is like a play that, if we get a pop up, maybe 26% off of this, up to $26 off of this most recent earnings, I would like to enter, I'd like to sell this position off personally. All right, next one. SmileDirectClub. So SmileDirectClub is a medical technology platform. You guys have probably seen them around. They are like the people who are kind of the, kind of the competitors to Invisalign, like actually really competitors to Invisalign. So what happens is you buy, you actually do like they send you I guess it's like a mold online. You put your teeth in it, and then you can end up buying basically braces that you wear. I think it's like 2 hours a day that you put your mouth in, and they will fix your teeth over a 6 month period. They're pretty expensive. I think like $2,500 starting. However, they actually allow financing through themselves and through like a side company, which is really good. And they become affordable if you do like the monthly plan. So this is a company I did a whole deep dive on before. I will put the link down below if you want to check that out. This company I really like though. Right now we're trading, it's got a $3.5 billion market cap. Shares outstanding are 386 million. EPS is a loss of 62 cents. There's obviously no dividend. And this thing had a huge push up. I was purchasing this around the $7 mark. I ended up selling it on my main portfolio like around $10.50. I wish I would have held on a little longer. So I'm starting to rebuild a smaller position. However, if it goes back up to 14, I'm probably not going to sell it. This is a company I want in my portfolio for the next 5 years because I really, really love this company. More and more people care more about their teeth, and people hate the dentist more and more. So if you can, fix your teeth and straighten your teeth, and it actually works, and it's over the internet, and it becomes affordable, because the bigger the company gets, the more money they can put into research and design, the more profitable they can become. Therefore, the cheaper they can actually make their braces for. So you can see they're in millions. 2018, I'm sorry. They did $423 million, I'm sorry, in total revenue. 2019, $750 million in total revenue. We take a look at their total net income. They lost $75 million in 2018, $115 million in 2019. So yes, they lost more money, but they also almost doubled their revenue from 18 to 19. This company is definitely a speculation at this point. This is not an investment. I would say, as most of these companies are not an investment, they're mostly speculations at this point. But like I said before, we are really looking for an aggressive return. So my goal is overall to have a lot more long-term winners than we do have long-term losers. I think this is a long-term winner. Total assets, 886 million. Total liabilities, 553 million. If we take a look at the technicals here, we have a resistance point around $14 and a very strong support down here at $7.41. We also have a reverse head and shoulders forming on the weekly chart. I think we bounce off of this $8 support, and I think that probably by the end of the middle of next year, we'll probably be up around $20.74. So overall, I really, really like this position. I really like SmileDirectClub long term, and I think overall, this is going to be a really good investment for me. So I feel pretty strong about it. Next one is GAN, G-A-N. I should do a deep dive on this. I really should. But GAN is a software service for online casino games and online sports betting. So best way to think is that they do like the back end work for companies like FanDuel. So obviously DraftKings, FanDuel, I think that they have a huge future. I made a whole video on DraftKings. So obviously, if you've watched that video or you haven't, first of all, watch it. The same way that they can scale is the same way that GAN can scale. If they can get more legislation to legalize betting in all these different countries, all these different, well, countries too, but all these different states within the United States, excuse me, then they're obviously going to be able to grow their revenues even more, which therefore is going to be great for GAN. I see a bright future for this company. Right now, small market cap of $450 million, 28 million shares outstanding, no earnings per share, 0 EPS, 0 PE ratio. I'm going to tell you right now, the financials are not really that good on this company. So this is displayed in thousands. So 2017, I'm sorry, they did $9.1 million in sales. That's it. $9 million. 2018, $10.5 million. So we do see a growth year over year. Total net, they lost $3 million in 2017. They lost $6 million in 2018. So that's scary. We don't have 2019 numbers yet. Obviously, we don't have 2020 even close, but that's really not that good. However, it's a very speculative company. You have to really believe in the online casino gaming and online sports betting when it comes to making an investment in something like GAN. 2018, we have $17 million in cash on hand. Well, total assets, I should say, not cash in hand. but $17 million total assets, total liabilities, $8.2 million. So financially, not the best company, fundamentally, not the best company, very speculative. You can see here the price of this freaking stock. This was trading down at $2 a share, pumped all the way up to 28, which is a 1,200% return, and then pulled all the way back to 14 bucks, and now we're up about 10% today. I started purchasing this stock. Let me check what's my average. I'm not gonna be able to find out what my average is, but I think it's something along like $15.50 or $16. So I personally hope it continues to sell off. I would love to keep buying the stock down at like $6. That'd be amazing. I don't really think that's going to happen though. Very, very speculative, but overall, I think that could be a huge winner in the future. Next one is Virgin Galactic. SPCE is the ticker. I'm going to do a deep dive on this company. So if you want to watch that, hit the subscribe button. Market cap $3.7 billion. EPS negative $1.56. 0 PE ratio, 0 dividend. Trading right in the middle of the 52-week high. There is going to be some technicals at play with this we're going to talk about for a little bit. So SPCE, or Virgin Galactic, is an aerospace company that provides human space flights for private individuals and researchers. So say you're super rich or you're a researcher and you want to go out into orbit, you can purchase a ticket for SPCE and Virgin Galactic for, I think it's $250,000, and they can send you up into orbit. Think of like space tourism. They're also working on a lot of other things. Like one of the big things they're looking at trying to create is like a super jet. They could basically bring you from like New York to California within an hour and a half, which would be huge. Once again, numbers are not the best here. So 2018, 0 revenue. 2019, $3.7 million, which is really like peanuts considered to, what the company could eventually become. They lost $210 million in 2019. So they took in $3.7 million revenue, lost $220 million. Not good. We'll see how 2020 numbers come out. In 2018, they had, let's take a look, $705 million on the books. And in 2019, they have right around $600 million on the books and $138 million in assets. This company is burning through cash like it's their freaking job. But the main reason I'm in this is because I think space tourism could eventually become a thing. I really, really do like the superjet aspect of it, but I'm really in it because I like the leadership and I like the chairman. Like, they have a really, really good CEO. Chamath Palihapitiya is a big backer of them. He's also on the chair as well as Sir Richard Branson. He's also on the chair, and he has a big, position in leading this company. So overall, it's a very, 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 very speculative company. Not for the faint of heart, and not for somebody who wants to take their money out of this thing pretty quickly. So as far as technicals are considered, we have a huge wedge forming here. Now, a pennant or a wedge is a continuation pattern. The pattern, obviously, we would continue our way up. This has been going up since IPO. Looking like right now we're going to bounce from 17.25 up to about 21, then back down to 18, then back up to 20, then back down. And eventually it seems like right around February of 2021, looks like we're probably going to get a breakout. I don't know if we're going to get up to 42, but it's looking like we're going to get a really nice push to the upside here. So overall, I really, really like this stock. I really, really like this company. I like the idea of the company, but right now it's a total gamble, but it's a gamble I'm willing to take. So the next one is Dropbox, DBX. You guys all probably know what Dropbox is. Let's take a look at the fundamentals. So Dropbox is essentially an online company that provides online file storage. I literally never used Dropbox, and I started making these videos. I started using Dropbox, and I was like, this is a game changer. Like, this is insane. I can literally drop like a 40 gig file onto Dropbox Cloud and then go grab it on my other computer in like 5-10 minutes. It's insane. So overall, definitely has been a game changer for me and for my life. And on top of that, I feel like they're probably a little undervalued, maybe fairly valued, but let's take a look at a quick summary. $7.3 billion market cap, EPS of 8 cents, PE ratio of 230, which is just nuts. So it's trading at a high multiple. 2019, they did $1.6 million in sales with a net income of $53 million in losses. Not the worst. I mean, they've done a lot better. 2018 was $1.3 million, and they ended up losing like, what is this net income? They ended up losing $485 million. So they've gotten a lot better at burning cash, but they're still not profitable. Overall, last year they had $2.6 million in total assets and $2.6 billion in total assets and $1.89 billion in total liabilities. This company has just been a consistent downtrend year over year for the past, 2.5 years now. Overall, this is a very risky investment like many of them, but I think that it's pretty fairly valued. I'll do a deep dive on this company for you guys in the future. Short term, we could see it down here at $16, but I do think that once we hit 16, we'll find a bottom. I'll continue to buy, and then we'll probably catch a bounce. Ooh, now the last one, I'm not even going to look at the financials for this one. Planet 13 Holdings. Let's just get on this. Planet 13 Investor Relations. So Planet 13, think of it like Dave & Buster's for marijuana, but a lot more. A lot more. So Planet 13, I think they currently have one in Arizona and potentially, I know there's, California and Nevada. Yeah, I know the one in Nevada. So in Nevada, they have a retailing space. So they've two of them, right? The first one is Planet 13 Superstore, and then the second one is a dispensary they own called Medizin Dispensary, which is play on words. But Planet 13 is kind of like a huge Dave & Buster's, but for adults and for, people who indulge in marijuana. They also have another place in California, which is just like one of their retail locations. Like I said, they have two in Nevada, one in California. And that one's opening in H1 2020. So 2021. I don't know. I have to look. I don't know if they're still opening that one with the whole, Roni situation that's been going on. They also own in-house brands and wholesale. So they have 3 cultivation facilities, 3 production facilities, multiple top SKUs in Nevada for probably like different chocolates, different gummies, maybe different like vapes and stuff like that. 29% of in-house sales in Q2 are Planet 13 brands, which is really good because obviously, you make a profit when you sell someone else's brand, but you make a much deeper, better profit when you are selling your own brand. This is more of a play on if marijuana becomes legalized. I hope I can even say that word. I know a lot of people get demonetized for it. Now, this is huge if, Mary Jane can end up getting legalized in the United States. Right now, this is a pink sheet. So this is a penny stock. You can't even buy this on Robinhood. This is a straight up YOLO. This is a play where, I've been playing this. I've been purchasing this for a pretty good average, but this is a straight YOLO play. This is not something I'd be dumping your hard-earned money into, hoping that, it's a safe investment for the future. This is not a safe investment for the future. And overall, that's kind of what I want to let you guys know about this portfolio. And I've said it before, this is not a safe portfolio. This is a very, very, very aggressive portfolio of companies that I believe can have huge potential returns in the next couple of years. And probably what I'm going to do is a deep dive on every single one of these companies in the future and a deep dive on any company that I'm going to buy. For now, this has just been an update to let you guys know what I've been buying over the past month, and I do one of these every single month. So if you like this video, I know it's not as professional as the other ones, but if you like this video, hit the like button, comment down below, subscribe to this channel, and until next time, guys, I'll see you. Have a good day. Peace.